Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome to our video. In Part 1, we'll explore why investing in AI wrapper startups can be extremely risky. You'll learn what makes these companies different from those that own their AI technology and why that matters for your money. Let's dive in. Have you noticed how every new app claims to be a revolutionary artificial intelligence solution? In early 2026, the market is flooded with tools that promise to write your emails, organize your life, or even manage your finances using advanced AI. However, beneath the surface, many of these companies don't actually own the technology they sell. They are what the industry calls wrappers, because they simply put a shiny user interface on top of a model owned by OpenAI, Google, or Anthropic. Think of it like renting a house on land you don't own. You can paint the walls and buy nice furniture, but if the landlord decides to sell the property or raise the rent, you're out on the street. Investing in AI-powered tools that lack proprietary models is a similar gamble. You're betting on a middleman in a world where the primary suppliers are becoming more powerful every day. If a startup doesn't own the brain behind its product, it has no foundation to stand on when the market shifts. The big risky problem with tools that do not own their AI. The most significant issue with AI wrappers is the total lack of a competitive moat. In business, a moat is a unique advantage that protects a company from competitors, such as a patent, a secret recipe, or massive infrastructure. When a startup relies entirely on a third-party API, application programming interface, they have no moat. Anyone else with a credit card and a basic understanding of coding can build the exact same tool over a weekend. This creates a crowded market where dozens of companies offer the same features. Since they all use the same underlying model, the quality of the output is identical. When the product is the same, the only way to compete is on price. This leads to a race to the bottom that eats away at profit margins. Why would a customer pay $30 a month for your AI writer when 5 other apps offer it for $5? Furthermore, giant tech companies pose a constant threat to these small startups. If Apple or Microsoft decides to add a single feature to their operating systems that mimics what a wrapper app does, that startup can lose its entire user base overnight. We've seen this happen before with flashlight apps and PDF converters. If your entire business model is just a feature of someone else's software, you're living on borrowed time. Why you cannot win a price war against giant tech companies. Economics is the silent killer for startups that don't own their models. Every time a user enters a prompt or asks a question, the startup has to pay a fee to the AI provider. These API costs are often the highest expense for a small company. In contrast, the big tech companies that own the servers and the models have much lower operational costs. They can afford to give away for free the very same service that a small startup has to charge $20 for just to break even. Now you understand the big risks behind AI wrappers and why relying on third-party models can be dangerous for investors. Stay tuned for Part 2, where we'll cover how to spot real AI companies that are worth your investment. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.